Ministers meeting over the weekend gave Japan the green light to press ahead with their monetary stimulus. Joining me down the line to discuss the potential impact on some of your favourite currency pairs is Neil MacKinnon from VTB Capital. Neil, if we start by looking at the Japanese yen against the US dollar, given the magnitude of the Bank of Japan's actions, there has been some suggestion that this pair could reach the 103.16 level and ultimately through the psychological level of 105. Ministers said they will tolerate the yen slide for now, but how much longer would this really be viable for? And what is your outlook for this pair?
Well, the Bank of Japan have recently embarked on a fairly radical change in that monetary stance. They're looking to double the monetary base by the end of 2014. And the foreign exchange markets already anticipated that. Of course, the yen is an indicator of the monetary stance, and with the Bank of Japan looking to loosen policy, we've seen quite a considerable appreciation in the currency already. Looking at the technical charts, the key levels that I have in mind, and this is looking at a technical chart back to 1995, key retracement levels are 103, which we're not too far away from. Then it's 112, and then it's 120. And basically, I think that those levels provide good staging posts, give us a good idea of where the yen could go to. So I'm still happy to advise short yen positions. I think this is what happens, and of course that will do quite a lot in terms of improving the profitability and competitiveness for Japanese companies, which is why the Nikkei, the Japanese equity market, is up some 40% year to date.
It is a bit of a dollar story, and it has been soaring against most of its peers. Is it too early to talk about the Fed tapering off QE? And if we take the dollar against the Swiss franc, some analysts are recommending longs on the ground that this pair has now broken out above a downtrend from last summer's peak. But what are you expecting from the dollar franc in the short, mid and longer term?
Well, I think longer term, I think the prospects for the US dollar are starting to look a lot more attractive. The main macro reasons would be that the US economy is holding up reasonably well. It seems to have been withstood a degree of fiscal policy tightening, which has impacted the early parts of 2013, and we've seen that in sort of recent monthly indicators, whether it was industrial production, retail sales, some of the Fed regional surveys. But one of the good news stories is that the US federal budget deficit is actually improving quite rapidly, and the deficit, which stood at 10% of GDP 2009, is expected to be something like 5-6% this year. So it's quite a remarkable turnaround. It's quite an astonishing degree of improvement, and I'm not sure that that's fully recognized in the market. The trade deficit is improving. You strip out China and oil, China would have a surplus. That means that there's a shrinkage in the global supply of dollars. We saw recently with Ben Bernanke's speech Friday, where there was warnings about excessive risk-taking, stories from John Hilsenrath in the Wall Street Journal, widely regarded as an unofficial mouthpiece for the Fed, that some unwinding of the Fed's bond buying program is a possibility, and it could well be that if the US economy can get onto a firmer footing, which I think it can, then the Fed might be the first major central bank to exit quantitative easing. So together with the longer term fundamental stories about shale gas production, improving energy efficiency for the US relative to other major economies, a lot of these factors combine to generate a positive story for the US dollar. So I actually think going into through the rest of this year into 2014, I would start to look for the US dollar to make some sort of improvement against the major currencies.
Our last pair is the pound dollar. Now, the discussion of the UK leaving the bloc has come to the fore once again today. Subsequently, analysts are saying there will be a significant bordering on dramatic sell if the UK edges closer to exiting the single market. Does this have the potential to spook investors in your opinion, and what is your forecast for this pair?
Well, I think it's the issue of UK's participation in the EU is undoubtedly an important theme, and may become more important. It may maybe create some political worries. Prime Minister David Cameron's future perhaps on the line, with his own party becoming more vocal in looking to exit the EU. So yeah, I'm in favour of pulling out. I don't buy the story that it would be apocalyptic. I think far from it. I think that the Eurozone is turning into a zombie economy with a zombie banking system, and I think the UK would be better off out. But I think that, looking at the euro sterling cross rate, certainly you're at 84, 85 now. I think 88 is a big resistance level. Looking at the chart, it's approximate trend line resistance from the highs we had up near parity at the end of 2008. And I think that 88 is probably a barrier on the top side now, and I think that sterling has the potential to return to the sort of levels just below 80 at some stage over the next 12 months. It seems quite a bold prediction to make, but I think there is certainly scope for some appreciation in the euro. I think much is going to depend on how the debate about the EU evolves, but I actually think that if sterling were to exit, it would actually be positive for sterling.
Neil, thank you for your insights today. Well, that's all for today's Targets and Focus, but click back to Dukascopy for today's others programmes, including Press Review and our Week Ahead interview. Goodbye for now.